Hey guys, so a lot has happened since I left you. I went on holiday for a little bit, but I'm back now and I'm going to show you a few of the companies that I've been looking at and I'm going to make a purchase this video. So wait around to the end, see what I buy. But before that, I'm going to show you my watch list, what I've been looking at and kind of my decisions about my portfolio recently. So let's get straight into it. My overall return is 12,000 at the minute with a rate of return of 104.4%. which is great. Overall value of the portfolio, my individual stocks portfolio is 46,614 and I'm just going to cut straight to it. So in my last video, I showed that I was making a buy of the Fair Isaac Corporation. Essentially, my conviction in FICO is wavering a little bit and I'll explain to you why. So I bought FICO earlier in May. I bought FICO last month in May. I bought it at around $1,756. I bought it because it had a very sharp drop, and this was because Bill Pulte, a government official, had commented on the fact that he didn't like FICO raising the prices of their FICO scores so fast and by so much. I think they raised FICO scores by about 40% last time they raised them, and because they have this monopoly, he was going to look into their practices. This made the stock drop a hell of a lot, and I thought this is my time to buy into such a high quality company. Now, when it came to FICO, they were already trading at a massive premium. Their PE ratio at the minute is 75.72. This is way higher than what I usually purchase at. 75 is very high for me. But because of the quality of the company, I decided to enter the position. Now, since then, I went on holiday and Bill Pulte made another suggestion about looking into FICO, and the stock dropped down to 1,500. At this time, I was on holiday. I was not paying attention to the stock market really. And I missed this opportunity to buy in. It was unfortunate, but what it made me realize is that the stock is actually still really, really highly valued in terms of its PE ratio. And this means that any kind of disruption to the stock can cause huge drops really quickly. So we've seen a drop from 2,200 down to 1,500 in the course of less than 10 days. And this kind of put into perspective for me that FICO is actually quite a risky play here. So although I love the company, it's a great company, I do believe it's overvalued. So I'm going to exit whilst I am £10 up. I'm going to take the £10 and I've decided to move the cash that I have in FICO, which is 1,090, as well as the cash I have left over in Salesforce, 467, into a new stock. So over the past few days, I've been looking at stocks to buy, and this is what I've come up with. And I'll start it off. I'll be quick, get straight into it. The first stock that I've been looking at is Next Tracker. Now, you probably never heard of this. It's really unspoken about. It is a solar stock, and essentially it is the number one smart solar tracker in the world. So they do not make solar panels. What they actually do is they make the trackers that follow the sun around the sky, and they position them on the back of the solar panels. So they kind of make large scale solar farm designs, but they don't own the solar farm. They simply sell the technology to the people who are making this solar farm. They also create software for solar farms. You might be thinking, why am I looking into the solar industry? This is why I'm looking into the solar industry. So solar capacity has been growing incredibly fast in the past few years. I mean, look at this graph. It's almost exponential. It's the most added energy type in the world at the minute. 33% annual growth last year, 85% between 2022 and 23, and then before that 47%. Now this comes because China is making loads of solar panels for very cheap. They've had a big breakthrough with solar panels. And this kind of trend is an increasing total addressable market just shows that solar farms is an increasing total addressable market, or TAM. And I wanted to be a part of that. I wanted to get in on that, because I do think that solar power is going to be one of our largest sources of energy in the future. Now, how does Nextracker look in terms of its fundamentals? We have a look. It has a free cash flow yield of 7.919%, which is really high, really, really good way to start it off. A PE of 16, and recently it's gone up in price quite a bit with its latest earnings, which you can see the effect of its latest earnings here. It really popped. If we have a look at it with its latest earnings, and its latest quarter had quite a high free cash flow. You can see there that it is growing in free cash flow, which is great to see. Its revenue is also going up. It went up 18% last year, which is great to see. So I do think it is an attractive stock. However, the reason I do not want to buy into this stock is because of, oh dear, just deleted a tab that I didn't want to delete, is because of this man here, Donald Trump. Now, he has proposed a tax bill that essentially cuts down on the solar industry and basically green energy in general. Usually when it comes to green energy, it's really usually quite difficult to justify the price of the green energy. But with solar panels are becoming so cheap because of Chinese manufacturing that I do believe solar has plenty of room to grow. However, Donald Trump doesn't believe so, and he's passed a tax bill that essentially takes away the 30% tax credit that was given to solar panels for homeowners. Now, this doesn't directly affect Nextracker, but it does affect the solar industry overall. Also, Donald Trump is likely to impose high tariffs on the Chinese solar panels, which means that the industry as a whole in the US is going to grow slower. And Nextracker has about 60% of its revenue comes from the US, which is very annoying. However, most of the growth of the solar industry comes from China and Asia. So it might be worth looking into some Asian stocks, solar stocks. But yeah, that's Nextrackers, and I'll move on from that. Google is another attractive stock to me. It has a really low PE at the minute. It's a giant tech company. Everyone knows it. Everyone uses it. It's trading attractively. It's trading very cheap in comparison to its peers as one of the magnificent seven. Now, with Google, it has almost everything going right for it. Free cash flow grows pretty quickly. Over the 5 years, 20%. Over the 10 years, 19%. And the issue I have with Google is the whole narrative of AI replacing them. Now, when I look to the future and I think about search in the future, I do not think that search is going to look the same as it does now. And I do think, however, that Google will probably still be the go-to search/AI search bot. But I just don't see how they are going to monetize it. I think that there will be a transition. I think that they will be able to monetize it eventually. Maybe they'll just put ads when you ask the AI. Maybe they'll just put ads like Meta, Facebook does. You know, when you're scrolling on Instagram, they might just show you an ad randomly when you search something. But I think that it might not give the best returns in the midterm whilst it transitions its Google search into, you know, Google Answers, or essentially using the AI chatbot. So this is why. But with Google, I love all of the other sections of it. YouTube is amazing. So please, YouTube algorithm, give me more subscribers. And the rest of it, Google Cloud, growing really quickly. In the other bets section that we have here, that is Waymo, autonomous vehicles, autonomous driving. That's a really cool thing. You know, they've got loads of rides. We can see here, Waymo weekly rides is growing really quickly. So I think that that's another tailwind for them. And I like the rest of Google's business. It's just the Google search that I just see the transition being a hindrance to Google stock. Moving on from Google stock. So this kind of brings me to a time when I thought, actually, let me just review some of the stocks I already have. It might be time to consolidate the portfolio I already have. So if I look at Texas Roadhouse, its valuation is, I think, attractive. 3.87 free cash flow yield. I think that is a very attractive free cash flow yield to Texas Roadhouse. We can see so clearly that they are consistently growing revenue. In fact, recently, since 2020, they've increased faster than they ever had before, and their revenue is growing so quickly. 15% last year, 15% over 5 years, and personally, I really like the look of Texas Roadhouse at the minute. Their free cash flow is spiking, is going through the roof. They're currently growing their number of restaurants very nicely. It's just up and to the right, which is exactly what you want to see. Also, the restaurant industry is kind of struggling at the minute. And I believe that because of Texas Roadhouse's strong position in the market, where they're not struggling financially at all, they're still bringing in money, they're still increasing their cash flows. I believe that they can take the opportunity to take market share from other competitors in the space. When it comes to growth estimates for Texas Roadhouse, I can simply put in a free cash flow per share growth rate of 15%, and I can say that I will exit the position when the free cash flow yield is at 3.5% in 5 years' time. So by 2030, I project, this scenario projects $407 to be the stock price. This is a 17.3% annual return from today's price. I think that Texas Roadhouse right now is an attractive buy. So moving on, we have Amazon. Amazon, and what used to be the largest chunk of my portfolio was Amazon. Since then, HIMS has outgrown it. That 50% growth has meant that it outgrew it very fast. Amazon, I still believe, is undervalued, and let me show you why. When we look at Amazon, we can't use their free cash flow yield because Amazon is one of those companies that just continually reinvests, puts all their money into capital expenditures and reinvests the money into their business, which means that they don't really have any free cash flow to show at the end of it. However, we did start to see, before the AI boom, them rapidly increase their cash flow. They went from minus 30 billion to 50 billion, minus 30 billion to 50 billion in about 2 years. That's an $80 billion change in free cash flow there. And I think that because of this, they're hiding their efficiency. Since then, they've been investing in CapEx a lot. So with Amazon really is an AI play, and I will show you why. Amazon Robotics is going to really, really increase their efficiency. Amazon Robotics develops and deploys robots to assist in the warehouse operations and delivery process with the goal of improving efficiency and safety for employees. They've deployed over 750,000 robots across their network. People don't see Amazon as a robotics play, but it totally is. They've got mobile robots in their fulfillment centers. They're going to save a lot of money in the long term. They've got robots like Vulcan that have sense of touch, allowing them to pick and stow items with greater precision. And they've also got drones, and the drone industry is really growing very quickly, especially with the war in Ukraine. And now moving on, Amazon also they don't own Starlink, but they are creating a rival. They're creating a rival competitor called Project Kuiper. Now, Starlink has been essential to the war in Ukraine. Absolutely essential to the war in Ukraine. Essentially, Starlink allows for internet connection anywhere in the world, so you can be in completely remote location and it will give you Wi-Fi or internet connection. It's been so useful in the war in Ukraine because it's allowed for integration of drones anywhere they want, so they can fly the drone with better connection, and it's been just totally essential. So Amazon are entering into this game. It's a power that we didn't realize Starlink would have in warfare. Amazon also have Zoox, which is their autonomous taxi. It's like their Waymo. It's like their Tesla robo-taxi. And this is set to release very soon. So Zoox is another promising play for Amazon. All of these obviously very small. Amazon Web Service obviously is a crazy grower for Amazon. If we look at AWS, just AWS, it's been growing very quickly over the 5 year, 24%. It's just up and to the right. And this is growing their margins incredibly fast. They're the largest player in cloud hosting, and they are the largest hyperscaler. Now, moving on from Amazon, we have MasterCard. Now, MasterCard has dropped about 4.5% today, and that was on the announcement that they are talking about using a stable coin, which is a form of crypto, to do some sort of transactions. Now, I don't think that this is much bad news at all. This is topped off with the news of Israel striking Iran as well. So it's kind of a double negative on MasterCard. And MasterCard, I think, is attractively valued at this price as well. It's one of those companies that you can look at and just think it is the perfect fundamentals. I mean, look at the free cash flow. It's just perfect. Pretty much no dips in the free cash flow at all. Growing incredibly quickly as well. I mean, the past year, 40%, up 40% in the past year. Over the 10 years, 16%. Over the 5 years, a bit slower, but over the 10 years, 16%. 2 years, 20.9%. It's growing so quickly, and I believe that it's undervalued at this price, especially with this drop of 4.45. If we have a look at the projection for MasterCard, we can input simple free cash flow per share growth of 15.98 and a free cash flow yield of 2.95, which is a bit less than what we're currently trading at. And you see a return from today's price of 16.13%, or about 16% over the next 5 years. And I think that it might be time to consolidate my portfolio. So this takes me to the last of my stocks that I currently hold already that I think is attractively valued, and that is S&P Global. Now, S&P Global is a company that has many different revenues. It has the market intelligence side of things. So they sell intelligence such as the intelligence we're looking at right now. So all of these earnings showing up on market intelligence, all of the price movements, this is probably all from S&P Global. So they will sell this to Qualtrim, which is the software I'm using right now. And they sell this information to Qualtrim, and that's the market intelligence side of things. And then they have the ratings business. So they rate debt for markets all around the world, just globally. And they have a duopoly in that with Moody's. So it is S&P Global and Moody's. They rate the debt of large companies, and they rate the debt of countries. And you almost have to get a debt rating from S&P Global in order to increase your debt or increase your leverage. So they've got those two large sectors. They've also got the indices. They own the S&P 500 in terms of the indice, the S&P 500 index. So whenever you buy into your S&P 500 ETF, you are in fact paying S&P Global in a very, very minor way, very, very small. But this company, I think, will pop as soon as interest rates start to fall. As soon as interest rates start to fall, we will start to see people increasing their debt again. So they'll want to renew their debt. Companies are going to want to renew their debt. And for that, they're going to need more ratings. So, the ratings, if we have a look at the ratings business, it's only really starting to pick back up again. This was when we had interest rates increase a lot, and you can see, a lot of the ratings, that's mobility, you can see a lot of ratings started to drop in this time. They weren't getting as much revenue from these ratings because there wasn't as much debt being taken out. And this is slowly starting to increase as companies begin to renew their debt again. Now, if there was an interest rate cut, like quite a large interest rate cut, I would expect to see this start to continue and reach the previous line it was at. So if we're looking at somewhere up here, this could be a huge tailwind for S&P Global, and I think it's trading at an attractive valuation of 3.6% free cash flow yield. But I don't think that might not happen anytime soon. So I'm reluctant to put more money into S&P Global, especially as it is one of my largest holdings already, fourth largest holdings, And, you know, if the Fed at the minute says that it's delicately trying to balance prices and jobs, and it doesn't seem like the chief executive officer at the Federal Reserve Bank basically wants everyone to be patient when it comes to interest rate cuts. So I think it might be another year until we start to get proper interest rate cuts. So for now, I'm going to hold off on S&P Global. So now it's time to actually decide what I'm going to do with my money. I also got a little nice cash pot of £9.60 that I got from a dividend from S&P Global. And yeah, so now we're going to get down to business. So first I'm going to sell Fair Isaac Corporation, and I'm going to sell most of it. I think I'll sell 1,020 of it. I'm going to leave about 60 quid in there just because I want to see what happens. I want to keep tabs on the price, which is kind of my position I already had. I had about £20 in there before, and I was just keeping tabs on the price. So I'm going to send sell order. Sorry, FICO, didn't stay with you for long. And then Salesforce, you've made me some money. Salesforce has made me some money. With Salesforce, I'm actually up 6%, but the FX impact is so major. Right, bye-bye Salesforce. I'll do the exact same thing just to see where I would have been in the future. Sell Salesforce as well. So there we go. We've minimized our holdings of Fair Isaac and Salesforce to about £90, just less than £90. And this is just simply to keep tabs on them. See what happens. See if my buy-in prices were any good. We'll see what happens in the future. All right, our cash pot is now 1,500, just under 1,500, and it's time to buy. And I think, personally, looking at everything that's gone on, I think it'd be a fool not to buy the small dip on MasterCard. Down 4% over 4.3% on the day, out 4% on the week. So I'm going to buy a little bit of MasterCard. I'm going to put a limit on it. What's the trading price? View order, send buy order for that, and we'll see what happens. Should buy it quickly. Hopefully we get a good price. And Texas Roadhouse. I'm going to put money into Texas Roadhouse. I think that it's attractively valued. I think they're going to take market share, and it's been a big winner for me, and I think it's going to continue to be a big winner. So I'm going to continue to buy into it. Put a limit on that as well. I think we'll go, I want to put about 620 in there. And yeah, we'll buy it there. Review order, send buy order. So we're really just consolidating the portfolio with the cash that I couldn't really decide what to do with. I had it in Fair Isaac. I think it wasn't such a great idea. These are taking a little while to go through, which is annoying. Got about 309 left, and we're going to put that in Amazon. We're going to increase our stake in Amazon. For this, I'm just going to buy and put everything in. You have insufficient funds. Are you joking, man? How much have I got? 309. Just buy it. I don't have sufficient funds. I've got what? Buy it, please. Right, we'd just have to buy 300 then. Oh, there we go. That was almost immediate. Whereas these are taking their time. Limit 563.69, so it's just bounced straight up. Sucks. All right, we'll have to cancel that. They've got to be having me on here. Almost 100% they're having me on. Whatever. We'll cancel both of those. We'll try to buy again. All right, buy. Limit 620 worth. 3 review order, send buy order. Okay, come on, buy this share. What else was it that I couldn't buy? MasterCard. Okay, so there's our buy for MasterCard. Just waiting on this buy for Texas Roadhouse. Come on, man. Right, I'm going to cancel that and try again. Go. Oh, there we go. We bought the shares. We have bought the shares, adding to our Texas Roadhouse position. Love to see that. How much have we got left? 54 quid. 54 quid left. Put it into Amazon. Send that. We bought. Okay, sweet. And that'll be it for this video. Thank you guys for watching. And as always, keep investing. Hit the like button, please. Comment what you thought of my indecision about FICO. And yeah, slate me, fully slate me.
I'm hopping out Ferrari. My house is 3 stories. I'm still independent cause Jive couldn't afford me. The meetings were boring.